John Kilduff is here, a founding partner of Again Capital and a CNBC contributor. So you're listening to Brian. What do you think we should, in this country, the break-even cost is what in general, and anybody below that is?
Look, I've always said below $50, you're in trouble. There's starting to be there's trouble out there in oil-producing land.
Because of the debt, or because
there's just the economics of it all. I mean, all the associated costs with getting the barrels out of the ground. I mean, it just adds up. The pipelines, moving it around, producing it, maintaining the equipment. I mean, the numbers are, the lowest costs I've been able to hear get driven down to are in the mid-30s, but that's a rarity for the most part.
We know that Saudi Arabia has a price target they need for their economy to keep going. Russia does. Who has the upper hand in this battle between Saudi Arabia and Russia?
Saudi Arabia, absolutely. I mean, they are the lowest. Their cost of production is in the single digits. I know people confuse what they need for their budget, which is considerably higher with their cost of production. Yeah. But no, they've gone nuclear here. Yeah. They did everything they could over the weekend to do and achieve the objective that we're seeing right now, which is this plummet in price. Not only did they say they're going to unleash more production next month, go over 10 million barrels a day.
They could go to 12 million barrels a day.
Absolutely, and they're talking about that, but they also gave huge discounts for next month's purchases of their oil. Unprecedented numbers. If I showed you the chart, it's a drop that's
massive discounts so that it puts extreme pressure on Russia. Does Russia reconsider its position?
They are sticking to their guns. I'll tell you that whatever happened at that meeting, it was more than just a polite business disagreement. It was a falling out between those two. The Russians are on the wire saying that they could withstand this price environment for 6 to 10 years based upon their cash reserves.
Do you look at this as the final shoe to drop in this dynamic between supply and demand in the oil market? It's obviously coronavirus has accelerated all the problems, but even people are writing in, even in 2000, a couple of years ago, they were having trouble at $45 or $50 breaking even. This has been a long time coming.
It is. I will say the good news here this morning is we're 20% off the lows already. We were down at 27 for WTI overnight.
20% the overnight, right.
The we're at 32 right now. So I wanted to get that bit of good news. But this is, Joe. I've talked about this for a long time. All this, to me, it was nonsensical for the Saudis to try to curtail production and prop up the price. They were only supporting their competitors, particularly the U.S. shale producers, who were benefiting from their actions. I'll tell you, last week, every Wednesday we have this inventory report from the Department of Energy, right? Comes out at 10:30, and it's just a geeky thing for us oil people usually. But the numbers last week were stunning in that U.S. exports jumped to a shattering record of over 4 million barrels a day, and U.S. domestic production ticked up to 13.1 million barrels a day. To me, that was it for the Russians. When they saw that, they were like, there's no way we're going to do anything but compete against these guys from now on. And on the heels of news that China had just bought a huge cargo of U.S. crude oil, not shale, but from the Gulf of Mexico, Mars production.
All right, ExxonMobil. Last week, I did speak with Chairman and CEO Darren Woods, who talked about how the yield was something that they were going to make sure they were still paying the dividend. That was stock that was yielding 7.3% before you see the 11% decline indicated this morning. What happens? Does that mean a complete shutdown of CapEx spending to try and keep up with that dividend, or is there just a point where they have to say, we can't do it?
On the math I've been doing between them and Chevron, some of the machinations they've recently gone through, and if they stop their stock buybacks, they should be able to maintain even that lofty dividend. So that's something to look at.
When the dust settles, who are the winners in the energy sector?
The well-capitalized rich companies. The strong will get stronger, the wealthy will get wealthier, and a lot of these shale heroes that got us to where we are today, unfortunately, are going to be in the dustbin of history.
You see collateral damage on all the new age energy producers? I mean, they just got completely less competitive than they ever.
They better make those windmills and solar panels a lot cheaper than they are right now, because they're not going to be able to compete. They're not going to be able to compete.
So does that mean that the fossil fuel industry is even bigger a year from now, or it's smaller because of all the carnage? So
here's what we're going to have to watch out for. If you look at this historically, when the Saudis did this to Venezuela back in 1998, and crude oil got under $10 a barrel, by 2000 we were pressing on $30 a barrel in a short amount of time. President Clinton at the time released barrels from the Strategic Petroleum Reserve to calm the markets down a little bit. But the U.S. oil sector never recovered for more than a decade. we got fields shut in that never came back, and it wasn't until the 2010s or so when the shale became profitable again, partly because of $100 close to it oil, that it made them be willing to take a chance. So the worry here, Joe, is that they take a beating, we lose this production for an extended period of time, and we're back in the soup. I mean, that's what I'm more worried
Andrew,
about.
there have been people, Kathy Wood, a lot of the thesis on Tesla is based on replacing hydrocarbons. And I mean, you could look at collateral damage across a lot of different.
Tesla's indicated to open down more than $70 this morning.
Yeah, because those batteries, you can't compete with a gallon of gasoline. It's only going to be like a
$1
or so.
Transition is going to be even
70
longer.
miles.
All right.
Yep.